Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menashe. A recent Wall Street Journal article laid out the rising cost of home ownership in a very clear way. From 2019 through 2025, the annual cost of owning a home across the U.S. rose from about $20,600 to $28,600. That's a 39% increase compared with a 26% increase in the Consumer Price Index. The biggest increases were not just mortgage payments. Insurance rose 72%. Home maintenance rose 85%. Emergency repairs rose 175%. The article was written for homeowners, but the same forces apply to investors. A landlord doesn't get a different price for a roof, a plumber, an HVAC compressor, property insurance, or property taxes just because the property has tenants. In fact, investors can be more exposed. A homeowner can defer a repair. They can live with an old kitchen, a worn carpet, or a tired bathroom, but in an apartment building, deferred maintenance becomes tenant dissatisfaction, and tenant dissatisfaction becomes turnover. Turnover becomes vacancy, concessions, unit turn costs, and eventually lower operating net income. That's the part that many financial models miss. For years, many apartment acquisitions were underwritten with operating expenses growing at 2 or 3% a year. That assumption looked reasonable in a low inflation world, but it's no longer a safe bet. Yardi Matrix reported that multifamily expenses rose 7.1% year over year in 2024. Insurance was up 27.7%. Repairs and maintenance were up 8.8%. And Yardi noted that rent growth had slowed to only 0.6% year over year. That is a squeeze. Expenses have been rising faster than rents. Another Yardi analysis found that in the trailing 12 months ending 2023, total multifamily operating expenses rose 9.3% nationally. Insurance rose 18.8%, repairs and maintenance 14.2%, payroll and utilities 7.8%, and taxes 5.9%. Now, if you underwrote 3% expense growth, but actual expenses grew 9%, your spreadsheet was not conservative. It was just plain wrong. So let's put some numbers to it. Suppose an apartment property produces $1 million in annual revenue and has $400,000 in operating expenses. That leaves $600 of net operating income. If expenses rise 3%, that increases $12,000. That's fairly manageable. If it rises 9%, that increases $36,000. That's a $24,000 miss against the model. At a 6% cap rate, that $24,000 shortfall in net operating income represents $400,000 of lost value. That's before considering higher debt service, refinance risk, or capital reserves. Insurance is the most visible example. The Federal Reserve found that multifamily property insurance costs increased from an average of $39 a unit per month in 2019 to $68 per unit per month in 2024 in real terms. That's more than a 75% increase. The Minneapolis Fed also surveyed multifamily owners and found that property insurance doubled from 2021 through 2024, increasing more than 6 times faster than the Consumer Price Index over the same period. Some owners increased deductibles, they reduced their coverage, they shopped their policies, or raised rents where they could. But here's the problem. Higher deductibles don't eliminate the risk. They move the risk from the insurance company back to the owner. A cheaper premium with a massive deductible might look good in a budget until a claim arrives. That's especially dangerous in affordable housing, rent-collected housing, and older value-add properties. These assets have less ability to raise rents, and older buildings usually need more repairs, more maintenance, and more capital replacements. At the same time, rent growth is not uniformly strong. CBRE noted in their 2026 multifamily outlook that the effective asking rent is expected to remain low for much of this year, with many operators prioritizing occupancy over rent growth. High supply in the Sun Belt and some of the mountain markets are still dealing with the effects of a 50-year high of new supply. So investors face difficult combinations: higher expenses, higher interest rates, slower rent growth, and more concessions in some markets. And that changes the underwriting. The old question was, what rent premium can I achieve after renovation? A better question today is, what expense shock can the deal survive? Can the property survive a 25% insurance increase? Can it survive a tax reassessment? Can it survive a 15% repair and maintenance increase? Can it survive debt coverage test if its rents are flat for 2 years? Now, we had a property in Louisiana that we originally underwrote our annual insurance cost at $58,000 a year, and that was spot on for the first year. The next year, we got a quote for $350,000. We managed to negotiate it down to $250,000 with a higher deductible. That's a 300% increase compared to what we had in the original budget. Now, we did survive that, but it was a very painful experience. The lesson is simple. Investors are not immune from rising ownership costs. Multifamily is not exempt. Larger scale gives you some purchasing power, but it doesn't walk back inflation. It doesn't eliminate weather risk or labor shortages or tax pressure from the city. The winners in this environment will not be the operators with the prettiest rent growth assumptions. It'll be the ones with disciplined expense underwriting, realistic reserves, and strong asset management, and the humility to admit that yesterday's cost model might not work tomorrow. As you think about that, have an awesome rest of your day. Go make some great things happen, and we'll talk to you again tomorrow.